Hello everyone, my name is Kamal Manocha. I represent PMSAIF World. Today we have a very special guest amongst ourselves, Mr. Kenneth Andrade from Old Bridge Capital Management. And we have a very interesting topic and a very thoughtful topic which is apt given the current times, which is basically the more the investment cycle changes, the more it remains the same. And Kenneth would explain in detail how at different points of time, different cycles have played and have given opportunity to various fund managers to build wealth in different themes in different sectors. And what is the theme? What is the cycle that he's seeing which is going to play over say next decade? And we will cover more about that. Before we start, I would just give a quick introduction to Kenneth. He brings with him more than 30 years of experience, having managed equities specifically for 15 years. He has managed India's one of the most successful funds as a fund manager, and he founded Old Bridge Capital Management in 2015. And today, in Old Bridge Capital Management, he runs various alternate investment funds and portfolio management services. And he leads the ideation of investment ideas and also the investment process. Before I hand it over to Mr. Kenneth for him to take us through the entire topic, I would just like to play one quick AV which will explain the context of this interesting webinar. Awesome. I think this sets the context very sharply, and I am absolutely looking forward to hearing from you, Kenneth. Now, over to you. You're on mute, Kenneth. Kindly unmute yourself, right?
Yes. Thanks, Kamal, and thanks for inviting me for today's session. Now, while I've put the context of it in place as to what we want to, what I think is relevant in today's environment, it's an investing style that has brought us to the fore at Old Bridge to 2020 and 21, and that's how we are essentially executing. The thing about capex and capital cycles is that they always remain the same, and while we've highlighted three particular decades in time, okay, between the 90s, then the 2000s, and then 2010s, there was an investment phase for every three parts of this business. And while all of us identify capex cycles and capital cycles with investment in commodities, capex, infrastructure, etc., there we've just come out of a decade where you had a lot of businesses that invested in the consumer cycle also, and all of that paid dividends over the last 5 years and 6 years, and that pulled in a significant amount of new competitive intensity into the marketplace. So you go back to the 90s, and the 90s, while we had a minor capex cycle that came through in India, what also took place across the world is something extremely large in tech, and that was the formation of the internet, or should I say the growth of the internet cycle, which actually is playing out right now. So largely the industry cycles in every industry, or the capex cycle in every industry, continues to remain the same. It continues to go from a period of underinvestment to a period of overinvestment. Okay, when there's underinvestment, there's supernormal profits that come. Those supernormal profits take it to attract a number of new participants, and it goes into an overinvestment phase. When it goes into that overinvestment phase, the business goes flat, or profitability in that industry goes flat for a while because the competitive intensity is extremely high, and then it reverses the process, and that goes on and on. So we basically think that we are at the start of a new cycle. The new cycle is that we see, and the audiovisual that you just saw, we put it out somewhere last year, mid of last year, which is almost in July, August of 2020, just to highlight the fact that the underlying environment is shifting quite rapidly. The leverage that is there in the system is moved to the personal balance sheets, and corporate balance sheets have completely deleveraged. And that's what we're basically trying to highlight, that this time around, the previous 10 years, the best performing companies will probably be the weakest performing companies in the next decade, and that's where we are essentially are. So from a perspective of what we do, we essentially look at, we try and identify where we need to put capital to work within the decade, and if you get that right in the beginning, I think for the rest of the decade you run with a lot of momentum in some of those businesses as profitability continues to expand out there, and that's the cycle that we like to align ourselves with. Okay, so what the street normally calls us, or most investors actually call us, as value investors, and a large part of the cyclicality in these businesses, or when we form portfolios, a lot of these companies are available at significantly attractive valuations. And that's when we try to identify a lot of these companies, and that's when we try to put them together in terms of a portfolio. What is also required in this kind of investing is reasonable amount of patience, and a reasonable amount of inactivity, because some of these patterns play out for the entire decade. So we highlighted three companies in that portfolio, in that audiovisual presentation. And if you looked at all three companies, if Infosys did well into 2000, you also had a participation with Wipro and with Wipro, with a number of other tech businesses, including the DSQ, Silverline, etc. So there was not really stock picking. If you identified it at the beginning, you just rode with it right to the top with the whole pool of businesses. So what essentially happened there is profitability in that industry expanded. All companies did well. If you look at the next cycle that came through, one steel company did well, all of them did well. Simply put together, profitability in that industry expanded, and all participants participated. It's small, big, all of them became extremely profitable. And as we went into this decade, right up to 2019, you didn't have a single NBFC that lost money for you. Okay, you didn't find a consumer company that was struggling to demonstrate performance. All of them did well because from an industry pool perspective, the profitability expanded, and that's how we try to encapsulate all of it. So we try and anticipate these trends. We try to be early, and once you've been able to align yourself in, we just have to have patience and a relatively long periods of inactivity, and portfolio returns are normally significantly over any benchmark that is available. So that's where we are currently. I mean, I leave this with this brief introduction, and I will be happy to take questions and try and explain more of this and where we are in the market cycle right now.
Right, Kenneth. So the very first question that comes to my mind, I will ask all these questions from investors' perspective, right? Real practical questions. So over last 2 decades of history, your AV has shown, say, 27 years of history, so 2.5 decades. There have been many good, bad experiences that investors have had, in maybe reading these cycles rightly or wrongly, right? There have been many fund managers, and you have been one of the very successful fund managers, maybe amongst rare ones who have actually read cycles rightly. But over last these 2 decades, especially last 1 decade, because the experience of having reading of cycles been not that great, that is where investors today have learned an easy way out, or investors have learned a more fine way out, and that they have learned over the last 3 years, which they call as investing in consistent compounders, which are called investing in secular businesses. So those businesses which in the respective industry have highest market share, names like Nestle, Asian Paints. Let's not talk about stocks, but we understand, right? These consistent compounders where the return on capital employed is very high. So these are considered to be good, great businesses. And instead of getting into cycles, let's invest in these businesses and hold them for long to build wealth. This is the new, this is the new learning which investors have had. Maybe, this is the wrong learning. Maybe now we are entering into a cycle, where some of these businesses will drastically underperform and some of the other businesses will outperform. And we are seeing that over last, 8-9 months already. But because investors have learned it, basis their hard experience, bad experience, and now, again, relearning and trying to get into cycles is something which requires a lot of data, a lot of information. I'm not trying to debate which is right or wrong, but I'm leaving you with this thought because this is the foremost question that I want you to address to begin with.
So investors are not wrong, okay, in terms of buying good companies at good companies, but let me also tell you that all good companies don't make great stocks. Okay, and all great stocks are not usually good companies. Now, if I just highlight something that went between 2000 to 2009, now if you pick up the world's largest company by market capitalization, which is Amazon, and you plot it over a period of 2000 to 2009, it entered or it finished the tech collapse, the technology bubble collapse somewhere in 2000. It came back and it was trading somewhere around $80. Okay, this was in year 2001 approximately. And if you exit 2009 October, Amazon exited at a price of $86. So for 9 years, the business was where it was. Okay, something similar happened in India. Okay, and you had the peak of the, levers also peaked in the year 2000. And for the next 9 years, it didn't do anything till 2009. Something very similar happened to Infosys. It gave you a low single digit return during that period of time. And these were quality businesses, great companies, but they were very highly priced when they started off, and when they actually were completely coming to the end of the cycle, investors gave up. So you're seeing something very similar happen right now. So these are things that happen in every cycle. I mean, the quality business in 2007, 8, 9, and consistent compounders in that period of time was L&T, was Tata Steel, was even a Jindals at that point in time. The quality business in 1999 to year 2000, you take any of the technology business out there, they were quality businesses, extreme compounders, and they had been compounding for the previous 10 years. Exit year 2000, 2020, and an HDFC bank and some of the FMCG businesses, or those have been consistent compounders. Now we look at it from a different lens. Okay, and you take any of those names, you take a Tata Steel, and then you put an IVRCL to it. Both of them returns would have been approximately the same. One company doesn't exist. The second company went on to be larger. Okay, so there was nothing wrong with Tata Steel, but Tata Steel is a big name right now because it's done extremely well as a stock. But exit 2009 to exit 2020, if you look at these 2 points in time of Tata Steel, he's grown larger capacity. He's switched over his capacity to a more profitable mix. Okay, and compared to a bigger part of the cycle where he was taking on debt, now he's actually paying off debt. So it's become much more solvent. In the next 5, 6, 7 years, the quality definition of a lot of these names will completely change. So yes, these are companies that will be around for a long period of time. I mean, an Asian Paints, a Nestle, and a Levers will be there for a long period of time. But I just like to say, I just like to wrap it up in one sentence. Good companies do not make good stocks. We are in this business to buy good capital efficient businesses at a great price. Okay, and that will only come with a very different mindset. Our lens of looking at a business is through the cyclical nature of an industry, and we also believe that technology will have its cycle. FMCGs and these secular businesses will also have their cycles. Okay, and that's our way of actually picking companies. So nobody's wrong in this. We all have periods of time where we do extremely well, and there are periods of time where returns are extremely pedestrian. But we'll also have to have patience with those periods of time in our investing journey.
Sure. So the next question that comes to my mind is to just investigate it further. Given your so deep and so long experience, why do you feel for Indian businesses the cycle is going to turn, or if cycle has turned, what are the factors that make you or convince you to feel that now cycle is turning, and to what side is cycle turning? Could you please cover that as well?
No, I think cycle turn. It doesn't. I mean, so it's a new set of companies. So let's put it this way: how do you catch a how do you build, or how do you identify a company? Okay, how do you identify a company in an industry which is going to do very well? Okay, I just correlate what you said with your previous question also. Okay, India's largest sugar company, okay, which is Balrampur Chini, has seen 3 cycles, and all 3 cycles it's come through with debt free. Why isn't that a quality business? Okay, why isn't that a quality business? India's so to take any commodity, I mean, take a Hindalco, or even take an automotive business. I mean, so you'll have to look at how this graph essentially changes. Now, why do I think that we are looking at a different subset of companies that will deliver returns over the next decade? Okay, simply put, what drove 2010 to 2020 in India was the leverage of the household balance sheet. Okay, what drove India GDP from 2001 to 2010 was corporate India picking up enormous amount of debt. Okay, so what happened in 2001 to 2010 is happened in 2011 to 2020. In the first cycle, it was corporate debt which expanded, gave way to capex. Okay, at the end of 2010, corporate India was over leveraged. Okay, now when you're an over leveraged business, you can't throw more debt to get more growth, because I mean, if you already had debt, you're double leveraging, right? You're taking on more debt. In the last decade, something very similar happened, but that was on personal balance sheets. Okay. Now, when you have a leveraged economy, you don't project things like what the pandemic. You don't project things like the pandemic. But what you know is that any economic uncertainty means that the leverage is going to work against your favor. Okay. Nobody predicted the global financial crisis. But when the global financial crisis came in, the most leveraged part of the economy collapsed. It didn't come through till this decade. When household debt came up, nobody projected this, but spending will collapse. Okay. And then to grow your economy further, you need incremental amount of leverage to grow your economy together, right? So that's why we think that there's the end of the leverage cycle in personal balance sheets. The only unleveraged part of the economy today is corporate balance sheets. Okay, even the government is over leveraged. Okay. So I can make it a little more complex by saying a simple thing. Okay, every industry grows in line with GDP, right? So if GDP is growing at 5%, everyone grows at 5%. If you have to grow more than 5%, you need more money. You get it from the banking system, and then you grow higher than 5%. Okay, so that's how leverage plays out, or that's how incremental debt plays out. So when you don't have debt on your balance sheet, this is how you grow, and which is why we think that we are sitting at a standpoint that corporate balance sheets now have to fund India's growth. Okay, the second leg is demand. Where will demand actually come from? Our simple submission on demand is essentially going to come because India, or large part of corporate India, is now going to address the international economy or the global economy. Now, so when you address the global economy, you're addressing 100% of GDP. But when you're addressing the domestic economy, just India's story, if you're just playing the India story, you're addressing 3% of the world GDP, which is a larger footprint. And that's a space that I think now India will move in, or companies out of India will move in specific verticals and gain market share out there. So I said a lot of things, but just two takeaways. One is there's a global opportunity that is sitting out there. It's not going to happen across industry. You've seen India do it in tech. You've seen India doing it in pharma. You've seen chemical companies doing it. You will see engineering businesses do it. You will see commodities doing it. Okay, and you will see a number of smaller industries that are there. That's the demand side of it. Okay, India has the opportunity of going out and taking market share because we are cost competitive vis-a-vis the rest of the world. The second element is, can we do it? Yes. For today, all these companies that we see today have been in a 10-year, they've been paying off debt for the last 10 years, and they will be able to downsize, they'll be able to leverage themselves into this growth matrix. Okay, which is where we think that it will shift from a consumer economy to a much more larger industrial franchise that we have on the
ground. Right. So some of those businesses which have potential to add more leverage and have global presence and can cater to bigger markets.
Exactly.
Right, and maybe those could be industrial businesses or manufacturing businesses or engineering businesses.
That's right.
Is the area where you see return coming more than GDP, and that is where you see possibility of more performance there, right? So very, very well point made. So now I would also like to understand from you another conceptual point which I have been reading over my experience of 20 years. And I have been trying to learn it from various fund managers. But honestly, again, I am not 100% convinced on whatever I have learned. And that is a very simple thing, which is value investing. What is the meaning of value investing? I want you to please explain me, because you come across as someone who can, I think, explain to me That is why I thought it is a good forum for me to ask this.
So I put it very simplest. I put it very, very simplistically. Is find an industry where only one company makes money and the rest all lose it. Okay, and that is value investing.
Okay.
Why is that so? I mean, that's our format of doing it. Of course, price earning multiple exists, EV to EBITDA exists, etc., etc. But those are more relative valuation reports. When we need to look at a value investor, when you need to in our style of value investing, is try to find a business at its complete distress. Okay, and that's where you get the cheapest of businesses. I just highlighted a point in sugar, right? What happened in sugar? One company makes money all the time, everyone else loses money. You just pick up that one company at the bottom of the cycle, have patience, it will give you an extraordinary return on capital employed. Okay, you go back into, so you go back to 2017, 2005, 6, 7, 8, okay? And I'll give you two companies. There's a mid-sized contractor which was trading at 18 times earnings, okay, which no longer exists today. And you had India's largest paint company also come down to 18 times earnings. Okay, the mid-sized contractor had visibility of 4 years of growth. Okay, the paint company had its all-time low in margins and was trading at 18 times earnings. Now, where would you go? Everyone is a growth investor. Everyone went to growth. But it's very simple. No? When the largest company makes the minimalist of profitability, the rest of the industry doesn't make any money. So we try and highlight it with two businesses, and this is a bias too, and I have to admit that it has been in our portfolios for a very long period of time. We have two fertilizer companies in our portfolio. One is based out of South and one based out of North. Okay, these two fertilizer businesses, one trades at about 20 times earnings, the other one trades at about 11 times earnings. Now, these two fertilizer businesses account for 15% of the industry volumes. Okay, 15% of the industry volumes, but accounts for 100% of the profitability of the listed fertilizer companies. Okay, so they built a franchise on the back of a very inefficient marketplace. Okay, so these, according to us, are very high quality businesses because they have outsold, they are outmargined, and they are out profitable every single business on the country. Okay, fair enough. I'd have to just wait for the valuations to come through. But a lot of us find that these are very unattractive spaces to be in. I mean, who wants to own a fertilizer company today, right? I'd rather own a digitization company and whatever is happening on the other side of the world. But remember, even in that digitization space, when we first came across one of the IPOs that were there, this company had 600 crores of cash on book, and he was IPOing at 2,200 crores of market capitalization, and he was already making 100 crores of profit. So that is an absolute wise. You're getting a unique business, 100% market share, trading at 15 times earnings. You don't know where the market is going to go. Okay, you anchor yourself out there. When you look at the fertilizer company, the dynamics are very similar. 100% profitability market share, 15% market. 15% of market share. What happens if 15% goes to 25%? What happens to those companies' profitability? Is there an opportunity for growing from 15% market share to 25% market share? Over the next 5-year period, next 10-year period, they'll definitely do that. Okay, so value investing is very simply put. I mean, apart from looking at the relevant ratios, find very, very efficient businesses at the bottom end of their cycle. And when you've been able to identify them, just park yourself out there and wait. When you created 20 such names, or I would say even 10 such names, okay, you cannot underperform the market. Or rather, I say you can't lose money in the cycle. Yes, you'll have to go through a patience. You'll have to wait with patience, but you just can't lose money in the cycle. So that's our definition of value investing. I think if you I mean, it requires a lot of discipline and a lot of conviction in what you do. Sometimes even we lack that at points in time. But yes, those are times, and those are times where there are times in every cycle that these businesses actually come up.
So, can your definition of value investing be applied to understand the market capitalization of businesses in the sense that would value investing in your style necessarily mean picking companies from small and mid cap space?
Of course, always remember when an industry does badly, the company which is the largest in its industry trades at a small cap value, market cap. I mean, at the end of the day, Tata Steel went to 30,000 crores, right, of market capitalization, which is equal to some of the mid cap company valuations.
So, today when we know that things are becoming more, I would say, global, where smaller players are becoming bigger players and market shares are being taken by larger players, I would say one of the largest contributors to market cap in Nifty is the financial services sector, right? So there are though various number of banks, but the larger market share is taken by maybe top 2 3 banks. Similarly, I see this happening in IT, I see this happening in pharma, and likewise. So when larger businesses are becoming all the more large, right? The trends are like that. You talk about IT companies, you gave examples of Amazon, Google, and all. So why? How can one bring in so much conviction to identify some of those businesses which today are being ignored by market based on their obviously expected rise, right? And they turning around. And today markets are kind of not giving them thumbs up. Their re-rating will ultimately increase their market cap. There are, maybe revenue and profitability are the numbers which today are subdued or are expected to rise, right? So all these factors are not known. How to identify? So, why? Obviously, theoretical definition of value investing, even I understand, but from your perspective, I want to understand the knack. How to create a portfolio of those 20 companies? What are the factors to see? And how to build that conviction to hold those 20 companies in a time when we see that the larger businesses are becoming larger. How can I keep holding, a small fertilizer company or a manufacturing company or an engineering company? Obviously, you are convinced, and I want you to convince me with your logics and uh, against keeping, say, a portfolio which has stocks like L&T, stocks like Infosys, stocks like HDFC Bank, right?
So here again, we don't buy small companies. We buy the biggest company in its category. Okay, so the two fertilizer businesses are almost the largest businesses in their category by themselves. The digitization businesses that we own, they're the largest in their category by itself, but they do not have too much of market capitalization. Okay, there's one pharma business which is the second largest company by profitability in the country. Okay, and given the product pipeline, it could get to be the largest in terms of profitability in the next maybe the next 3 years. And all of these are trading anywhere between 10 and 15 times earnings. So what you necessarily need to be convinced about is not about capitalization of these businesses, and not that you necessarily need to buy small businesses. You have to buy the largest businesses in its category. If that industry expands, okay, you'll go all the way to the top. So just let me give you an example of something that I had missed very early in my life cycle. That's because I thought that industry didn't exist itself. It was a company. It was an industry in the OTR business. It was an off-the-road tire business. Okay, there's a company called Balkrishna Industry somewhere in the year 2000 or a little before that. It was not a very large industry. So you take back of the envelope calculation, the business. I mean, anyway, you used to calculate it. You used to top out at an industry size of about $1 billion, $1.5 billion, and then the mining boom came, and that industry boomed to almost $4.5 billion. And this company took maximum amount of the market share and the biggest part of the market capitalization that existed. So you were not buying a small company there. You were buying the largest company, but you were skeptical about the size of the industry, saying that "Itna bada, you put such a big, large capacity in place. Okay, for such a tiny industry, what do you do there?" And then the market expanded. So always look for big businesses in a small industry, okay, or big businesses in a big industry in a down cycle. Okay, we've all seen the telecom network business, right, and how it's done. Okay, it's a two-player market. But how many of us have the patience into the next decade to believe that one is going to do better than the other? Okay, so when it's a two-player market, the consolidation is done. You also know that at 130, 140 rupees ARPU, nobody makes money. 160, some companies make money, and 200, even at 200 rupees ARPU, 220 rupees ARPU, even the smallest guy will make the money. Okay, and that's the cycle. So I don't tend to believe that the bigger companies will continue to get larger market share, because even they run out of money at points in time. You take any of the large companies, okay. If you want to go back to Larsen and Toubro, it has multiple failures right through the last 2 decades. Multiple failures in a lot of verticals that it had. It sold out its cement capacity in the early 2000s. Okay, it got into while its O&M did well, he's doing a little bit of software here, there, and everywhere, and reasonably successful in that. But he's got a holding company which has been a complete disaster. If you look at the 10-year track record of that company, it's been flat. Okay, 10-year in terms of point-to-point price, you hardly made any money in Larsen and Toubro. So big companies don't always make all the money. You look at FMCG, look at paints. Okay, and look at the competition coming in. There's more competition coming in. So the minute the market gets large, you'll definitely have more competition. So you'll have to wait till the market fragments. Look at the guys getting higher market share. These are companies that will lead the next cycle.
So is your definition of value investing, a top-down approach or a bottom-up approach?
No, we use it very traditionally. We've got different ratios that work. It'll take me a long time to explain how it works, but anytime I find market capitalization sales is significantly low, or EV to sales is significantly low, and that business is I won't say losing money, but making more marginal profits, and that's the time you look at these companies. I don't mind buying high PE stocks if that EV to sales is very low. That's the ratio that we use. It'll take some time to explain as to why it works.
What are the factors that will help you determine whether the cycle that you're entering into has kind of reached its potential?
Oh, that's fairly simple. When the market starts fragmenting itself. When everyone wants to set up a housing finance company, it's the top. Okay, everyone and the private equity companies want to put up a housing finance company. It's reached the top. So we just wait for fragmentation to take place. There is still strength on the upside, but always remember the top of the cycle is always met with significantly more investment than demand can attract. Okay, no entrepreneur in this country or anywhere in the world has ever been able to calibrate supply in line with demand. Everyone puts in more supply than demand exists, and that kills the pricing power of that economy.
Do you think has pandemic opened doors for any particular segment or any particular small cycle to play out over say next 1-2 years?
I think the focus, and it's not good for the government's balance sheets. The focus will definitely go to the social sector. And when we talk about social sector, it has to be maintenance of your financials. Essentially, your financial services companies or your lending businesses. It'll have to go towards maintenance of healthcare and enormous amount of capital into that. So these two are going to keep the governments across the world battling this problem out. So it might create an opportunity for companies in this entire space, but a lot of that pricing might also be regulated. So you've seen markets react to that, and it's come to where it is. The second large one that we counting on is a realignment of global trade, given the fact that uh, China is probably not the most favored manufacturing nation in the world right now for various reasons. And I think that would also factor in a significant amount of change in favor of developing countries or developed countries.
In the overall context over next 3 years, apart from your businesses, I'm talking about the overall economy. Are you bullish on India's economy in terms of rise in GDP, given the current situation, or you are skeptical?
I won't say we are skeptical. See, adversity always brings out the best in us, and so what's happening right now is probably we needed it, because if we do not, Indians never react, are never proactive. We are reactive, and we always operate out of a crisis. We always do best when we are in a crisis. So it's a little sad to say this right now, but this entire pandemic has actually woken us up out of our slumber, and it's got us back to looking at things that matters the most. Okay, so it's created a cycle by itself. We will probably struggle for a year, 2 years, maybe 3. The government's going to have a problem with its balance sheet for sure, but I think we will be one of the more favored nations and nations which are blessed that we will continue to attract foreign capital into the country to fund all our expenditure, even government deficits, so as to say. So yes, I may not in the near term be very optimistic about the government balance sheet or the ability of the government to spend on traditional infrastructure and businesses or provide growth capital to the economy. But I think corporate India will find its way out, and that by itself is in the past has proven to create scale businesses out of India, globally scalable businesses out of India. I think we needed this cycle also.
So large capex businesses, which is your forte, wouldn't that be impacted because of government's balance sheet, getting impacted?
No, I don't think so. So we're not really looking. So let's put it this way: the global economic cycle is actually intertwined. That's also because the global economic cycle has got free float of capital. So if capital addresses one sector in the US, it basically it navigates itself to the same sector across the entire world. And two of the biggest opportunities that are standing, and this is there in multiple forums. So one is the decarbonization of the globe and addressing climate change. Okay, that includes realignment of your entire vehicle fleet, and relook at your entire power grids, and also your power plants. Okay, so that's one massive opportunity. Think about it this way: is that India generates almost 65% of its entire capacity of power through thermal, and if all of that has to change in the next 15 years, we are going through a massive capital expenditure. Okay, all driven by foreign capital, private equity, you and me in capital markets, and a little bit of tax concessions here and there. The government will just have to give us the format to go and make sure that it is implemented seamlessly. Okay, the entire plastic chain and the fuel chain is going to change dramatically. So there's going to be no liquid fuel probably in 25, maybe 30 years from today. Okay, so there's massive refinery complexes that have to undergo significant amount of changes across the world, not just in India. You're going to substitute coal, and you're going to feed into the grid a lot of renewables. The whole grid has to be relooked, not just in India but across the world. Okay, so these are significant changes that are coming, and if all the gas turbines have to be moved to hydrogen, okay, and not just in India but everywhere else, and this is the other opportunity that's staring us in the face. So I don't think it's an India specific cycle. We will also participate because we need to participate, otherwise we will be isolated in the world economy, and once all of this starts happening, you will see a massive global cycle which is playing out even in India. So that's where we've also anchored our portfolio. So we talk about manufacturing, we talk about capex, we talk about the capital cycle, but think about what all of this does. Okay, India peaked its gross capital formation at 35% as a percentage to GDP in somewhere in 2007 and 2008. That's a peak that we've been to, and then it's always hovered around 20, 22, 23%. Of that gross capital formation, of that capital expenditure that went through, almost 30% of it was power. Okay, and power capex is coming back. It's not coming back in the traditional format, but it's coming back. So so you just build up the chain from manufacturing backwards, and you will see every single segment of that market being extremely profitable. The front end, I mean, the global automotive market is $1.5 trillion. Just imagine if you continue to invent and innovate in those parts of the world, what could be the size and opportunity of that. So this time around, I mean, there is always apprehension. Stock prices are run up. The capex cycle is already there. Stock prices up 3 or 4 times X. But the size of opportunity is much significantly larger than what we've ever seen it in the last century. All of that will come in the next 20, 25 years.
Right. So now, off market, I would just like to ask one last question from you. You were one of the first mutual fund managers who were able to vision and pioneered your portfolio management service. In 2015, when PMS or AIF as a structure of investing was not that popular. Only the structure which was known to most investors was mutual funds. So why I'm going to ask this question, because we are the leaders in this industry. We present alternate investment fund space, right? PMS AIF world is high performance investing focused, alternates focused platform. And I today see that there are some of the PMS and AI players which have been applying for mutual fund licenses, right? So you have seen both these worlds. So what is your take? Would you also go ahead and apply for a mutual fund license, or what are your views in this regard? This is the last question, and then we will end.
Sure, Kamal. I mean, if you just look at a portfolio management product, an AIF product, or a mutual fund product, they are different wrappers to the same structure, right? So from a regulatory standpoint, all three of them, okay, have their relevance in people's portfolios. I can't take a mutual fund product and run it like an AIF product. Okay, I probably can do one part of the market there. So if I have to address 100% of an investor's allocation, okay, I would necessarily need to have the entire gamut of products available if I have to go mass market, right? If I have to go mass market. So yes, every structure has its relevance. What I do on the AIFs, I can't do with a mutual fund. What I do with a mutual fund, I probably can't do with an. I mean, it's senseless to have an AIF license and copy what I do with a mutual fund. So what we're doing with PM, the portfolio management product and an AIF product, is we run a product which has got no banks and which has got no consumer businesses. Right. This is very much in line with how we construct the environment going forward. When I'm in a mutual fund, okay, and people want to contain volatility in line with the marketplace, I cannot have such extreme views on running a product. But there are those kind of investors also that I need to address. So I'm trying to run an absolute return product over a period of time, which the portfolio management business and the AIF business allows me to do. Okay, and this is the way I structure it. Okay, but if I have to run a low beta product or businesses or a portfolio with low tracking error, it makes absolutely no sense to run that product out here because I'm not in competition with the mutual fund business. Okay, like you said, I have to be a high performance manager.
Got it. Thank you so much, Kenneth. It has been a pleasure talking to you, and thank you everyone for joining us today.
Thank you.
Thank you.
Yeah, I really hope this was useful. Thank you.
Absolutely, it was. Thank you.